Two founders start with the same idea, same energy, same ambition, same late nights. 5 years later, one of them is ringing the bell on a stock exchange. The other is quietly shutting down their company, with nothing left but a domain name and a story no one asks about. So what actually happens between I have an idea and we're going public? Because the distance between those two moments isn't just hard work. It's a series of levels. And most founders never make it past level 3. Level 1 is the easiest to enter. It's called the idea. This is where everything feels possible. You notice a problem. You imagine a solution. Maybe it's an app. Maybe it's a platform. Maybe it's Uber for something. At this stage, the cost is almost zero. No team. No product. No pressure. Just optimism. And here's the uncomfortable truth. Ideas are cheap. Execution is expensive. Thousands of people have the same idea as you, right now. The only difference is who actually moves to level 2. Level 2 is validation. This is where reality starts pushing back. You build a basic version, a prototype, something ugly but functional. You show it to real users, and most of them don't care. That's the first shock. You thought the problem was obvious. You thought the solution was brilliant. But the market doesn't respond to what makes sense. It responds to what it wants. So you adjust. You test again. You pivot. If you're lucky, you find a small group of people who don't just like your product. They need it. That's product market fit in its earliest form. It's fragile, incomplete, but it's real, and it's enough to move forward. Level 3 is survival. Now the game changes. Because building something people want is one thing. Building something that can survive is another. You need money. So you either bootstrap or you raise your first round. Friends, family, maybe angel investors. Let's say you raise $100,000. It sounds like a lot. It isn't, because now you have expenses, developers, marketing, tools, time. Every month that money burns. This is called your runway, and it's always shorter than you think. At this level, most startups die. Not because the idea was bad, but because they ran out of time. Level 4 is traction. If you survive long enough, something interesting happens. Growth. Not explosive. Not viral. But steady. Users start coming back. Revenue starts trickling in. Maybe you hit $10,000 a month. Then $50,000. Now investors start paying attention. This is where venture capital enters the picture. You pitch your company not based on what it is, but on what it could become. A billion-dollar story, told convincingly. And if they believe you, they invest. Let's say you raise $2 million. Your company is now valued at $10 million, even if it barely makes money. That's the second shock. Valuation is not reality. It's a bet on the future. Level 5 is scaling. This is where things get dangerous. Because now you're not just building a product. You're building a machine. Hiring fast. Spending fast. Growing fast. You're expected to double. Then triple. Then dominate. The pressure changes. It's no longer about survival. It's about speed. And speed hides problems. Your costs grow faster than your revenue. Your team grows faster than your culture. Your expectations grow faster than your actual progress. But as long as growth looks good on paper, the money keeps coming. Level 6 is the illusion of success. From the outside, everything looks perfect. Big funding rounds, headlines, interviews. Startup raises $50 million. Valuation hits $500 million. But inside, the math is starting to crack. Because growth isn't always profitable. In fact, many startups at this stage are losing money on every customer. They're buying growth. Spending $100 to make $70, hoping that one day it flips. Sometimes it does. Sometimes it never does. But the longer the illusion holds, the bigger the stakes become. Level 7 is the crossroads. Now the company has to choose. Become profitable, or keep chasing growth. This is where strategies diverge. Some cut costs. Focus on sustainability. Slow down. Others double down. Raise even more money. Expand aggressively. Both paths are risky. Because markets change. Investor sentiment changes. And suddenly, the money that was easy to raise disappears. That's when reality hits. Hard. Level 8 is the exit. This is what everyone talks about. The dream outcome. An acquisition or an IPO. If it's an acquisition, a larger company buys you. Cash. stock, or both. If it's an IPO, you go public. Your company is now traded on the stock market. Anyone can buy a piece of it. This is where founders become wealthy on paper. Early investors cash out. Employees with stock options finally see real value. But even here, the story isn't simple. Because going public doesn't mean you've made it. It just means the game has changed again. Now you answer to the market. Quarterly earnings, share prices, public scrutiny. The pressure never disappears. It just evolves. And here's the part no one likes to talk about. For every startup that reaches this level, thousands don't. They stall. They pivot endlessly. They run out of money. They disappear. Quietly. No headlines. No documentaries. No lessons, except for the people who lived it. Because the startup journey isn't a straight path. It's a filter. At each level, something breaks. The idea, the product, the team, the finances, the timing, and only a few make it through all of them. So when you see a founder ringing that bell, celebrating an IPO, you're not just looking at success. You're looking at survival. Years of uncertainty compressed into a single moment of clarity. But even then, one question remains. Was the outcome inevitable? Or did they just survive long enough to get lucky?